Hey, what's up everyone? My name is Scott and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And this video here is going to focus on option assignment, where specifically if you get assigned on any of your short options and you don't have enough capital to cover the assignment, what exactly is going to happen? Now, as always, before we dive in here, in case you are brand new to the channel, I just want to let you know that you can also find me on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, so option assignment is definitely not as scary as it may sound, and although I cannot give a blanket answer as to what will happen if you get assigned and you don't have enough capital, because every broker has the right to manage option assignment in their own unique way, but basically it will boil down to one of two possible things happening. So for example, let's say you sell a simple naked put option with a strike of 50. So ideally, this is primarily a bullish strategy. You want the stock to stay above 50 by the expiration date. But let's say in this case, you are wrong on the trade and the stock just plummets below the strike price. So come the expiration day, maybe the stock is at 45 bucks per share, $5 full below your strike price, and now you get assigned on that put option, which means you now have to purchase 100 shares of that stock at a price of 50 at your strike price. So buying 100 shares at a price of 50 bucks per share is going to cost in total $5,000. But what if you don't have that $5,000 in your account? Well, at this point, this is where one of the two possible things will happen. The first thing your broker could do is simply close out the entire position for you immediately. So essentially, your broker will take care of all these stock transactions on your behalf. It will buy the shares at 50 and then sell them immediately at the market price of 45 in our example, and it will just post the losses to your account. You're going to lose that money. So ultimately, if your broker had to buy the stock at 50 and sell them at 45, that's a loss of $5 per share times 100 shares for that one contract. That's an overall loss of $500 that you have to suffer. Now, the alternative thing that could happen is your broker could still allow you to buy those 100 shares, even though you don't have enough capital to do so. So your broker will use some of its own capital to help buy the shares and deposit those shares into your account. Now, at this point, your account balance will be negative and you will get a margin call. And a margin call is essentially a notification from your broker saying that you have X amount of time. It's typically between 1 and maybe 5 days at the most to fix this problem. Right, your broker is not going to allow your account to be in the state for very long. You can't simply just carry a negative balance into perpetuity. You have to fix it. And there are two possible ways you can fix this situation. The first way is you can deposit more money into your account to now cover the full capital requirement needed to hold those 100 shares, or you can liquidate existing positions to free up capital and then also satisfy the margin call as well. But of course, that solution is only required if you actually want to hold and keep those 100 shares. So the second way you can get out of this margin call situation is you can just close that new stock position. So once you get assigned on your put option and you have to take those 100 shares, you can just sell them in the market on the next trading day and just get rid of them and be done. But either way, whichever decision you decide to go with to fix this margin call situation, you have to make that decision and act on it within the time window that your broker gives you. Because if you fail to act by the deadline, then your broker will step in and close your positions by force at whichever price they can get filled at. And typically, that's not going to be at a good price for you. And also, I want to make the point here that even though my example is focusing on selling put options, all of this is applicable to selling naked call options as well. It's just going to be the inverse situation. Right? So when you get assigned on a naked call option, instead of having to buy 100 shares of stock, you're going to have to short 100 shares of stock. It's just the opposite. And again, if you don't have enough capital in your account to do this, you can, 1, add more capital to your account by either depositing money or liquidating existing positions, or 2, what you can also do is get rid of that short stock position by just buying the shares back. Right? You have the same possible two choices as with selling a naked put option. Now, as I mentioned at the beginning of this video, because every broker has the right to handle option assignment in their own unique way, you still need to call your broker and figure out exactly what they do for option assignment. So even though in this video I've broken it down to your broker making one of two possible decisions, you still need to call them and figure out which decision they're going to make. And I can speak for my broker, which is TD Ameritrade. In this kind of situation, if you don't have enough capital, you will still be able to enter the stock position, either long or short, but you will then get a margin call. And finally, in this video, I do also want to emphasize that this is mostly applicable if you are selling naked options. You still definitely can get assigned on credit spreads and iron condors, but those are much safer strategies, right? Because for example, if you sell a call credit spread and the stock just blows through your short call strike, well, you already have that long call that you can exercise to cancel out any obligations you have if you get assigned on your short call. And so with that being said, that's going to conclude this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my Skillshare courses, links in the description of this video. And lastly, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.